Imagine getting paid every single month just for owning the right investments. Today, I'm breaking down two of Canada's most popular dividend ETFs, ZWC and ZEB. These are by BMO. I'll explain how they work, the yields, the risks, and whether you should reinvest or spend the cash flow. If you're a beginner, this is the perfect place to start. I'm going to keep it very basic. Please thumbs the video and subscribe to the channel. I still only have like 80% of my views coming from non-subscribers, so I'm clearly doing something wrong. I'm going to leave two links in the pinned comment. One is for Interactive Brokers, which is an affiliate, and one is for a free mini ebook I created about Canadian finance. Most Canadian companies pay quarterly dividends, but certain ETFs, especially the covered call ETFs, pay monthly. That's appealing because it's like you're earning a steady paycheck from your portfolio. These ETFs hold dividend-paying stocks, and then the managers sell covered call options on these stocks to generate extra income. I don't own any of these stocks. I usually sell covered calls on my own, but this is for a more passive investor and someone that doesn't like to actively manage, which I do. I like to actively manage. This extra income they get from the covered calls gets passed on to you in the form of monthly distributions, not dividends, but I'm not going to get into that. It's a distribution. ZWC is a covered call ETF that holds a variety of Canadian dividend-paying stocks like banks, telecom, and pipelines. Taking a look at the top 10 holdings, hopefully you recognize a few of these familiar names. Currently paying monthly distributions with an annual yield of 6.43. So investing $10,000 will get you $643 a year or $53 per month, which is a great place to start. You wouldn't invest in these for the sole purpose of capital appreciation. That's not what it's for, but it's still nice to see that ZWC is up 7% this year so far, so in 2025 so far, and it's up 21% over the last 5 years. ZWB is another covered call ETF created by BMO. Again, the management expense ratio is kind of high, but this one is exclusively for Canadian banks. So it owns the big 6 Canadian banks. It earns quarterly dividends from the banks that pay, I think some of them have been paying for 140 years, which is probably BMO. And it also sells covered calls to create the monthly dividend or distribution payments. The annual yield is similar to the previous ETF, so it's 6.3% per year. So investing $10,000 will get you $630 per year or $52 per month. This is slightly lower than ZWC, but it feels more stable considering for now, Canadian banks, or I guess for the last 100 years, in my opinion, Canadian banks have been some of the safest dividend-paying stocks in the world. Again, you would invest in these for the stock price to increase, but it's still nice to see a 9% increase in the stock in 2025 so far, so for the first 9 months, and a 37% increase over the last 5 years. It's important to know the risks and trade-offs when investing in covered call ETFs, so you have a capped upside. Selling covered calls means if the bank stocks or high dividend stocks rally really hard, if they increase too much, you won't get the full upside. But these should be slow moving stocks, so that should be okay for the most part. And there's also yield versus growth. A high yield today, but lower long-term growth compared to holding something like XIU, which is the broad Canadian index, or VFV, which I've recommended many times on this channel, which is the S&P 500. So you'll get a payment now, but the growth over 30 years won't be as much as holding these other growth ETFs. There's also like, what is the best fit? These ETFs are more for investors focused on steady income rather than maximizing total long-term returns. So if you're wondering what to do with the money, if you're young, ideally you would reinvest them, or if you're retired, or if you need the income if you're not retired, then it's fine to spend it. Like, I guess another ideal is if you invest in your TFSA RRSP. Ideally, if it's in your TFSA, you can earn the 6% per year and then you can withdraw it tax-free. So treating it as a free paycheck. Imagine you're in the top tax bracket. If you earned $600 from salary, that's as if you earned $1,200, paid 53% tax and had the $600 for yourself. So it's nice to kind of have it in your TFSA, so that's tax-free. If it's in your RSP, one issue is that you have to pay tax on the withdrawal, so it's hard to use it as a supplemental income if you're not retired in your RSP. I would try to avoid this having this in a taxable account altogether, since you would earn the 6% and then pay tax on it. So it's likely 4.5 or 4%. So you'd only have that as your income, as your extra paycheck, or you'd only have that 4% to reinvest, which kind of defeats the purpose. If we do a brief overview, I was rambling there. I ramble a lot. I'm going to try to focus more on script-based, but that maybe we'll talk about in another video. So if we just do an overall recap, ZWC gives you a broad mix of high dividend Canadian stocks. ZWB specifically focus on Canadian banks, which are income powerhouses. Just look at the returns for some of them, again, over the last 100 years. Both ETFs pay you monthly and both trade potential long-term growth for a consistent and higher yield now. They can work well inside a TFSA or RRSP to make that income tax-free or tax-deferred. If you're young and you're focused on growth, these might only be a small piece of your portfolio, let's say 5 or 10%. But if you're focused on building an income stream or planning for retirement soon, they can be a great addition. Let me know in the comments, would you rather hold a broad income ETF like ZWC or stick with the Canadian banks through ZWB? Also, one reminder, clicking on the Interactive Brokers link below helps me out with my affiliate sponsorships. You don't even have to sign up. Just clicking the link helps me out. Thanks for watching and tune into the next one.